So today's lesson is going to be on daily bias. You guys can see my screen? Perfect, yeah. Today's lesson is going to be on daily bias selection, essentially trying to understand the direction of the daily candle. So let's just start with a blank screen and talk about some of the tools that I use to select my daily bias. So, okay. So we'll type it out. So what we're going to do is refine the tools in which we utilize to find our daily bias into a couple time frames, and then also from those time frames we're going to be looking at a few concepts. So on the highest time frames, so we're going to start with highest time frames, we're going to use a few concepts, and that's going to be, as we generally know, the idea of internal range to external range and external range to internal range. So this is going to be kind of our liquidity imbalance theory. It's a better way of saying that. So let's write that down in brackets. There's also a lecture on this, right? If that is a little bit confusing. So I'll assume there's kind of some retained knowledge from that lecture as we go through this one. Then, in addition to that on the higher time frame, we're also going to be looking at the idea of candle body closures, which is the idea of sweeps versus breaks of structure. This is also a concept that was taught to MMXM by an MMXM trader, right? And he personally mentored a few individuals with this specific method, and one of those people was T-Trades, who posted a YouTube video on it. And I've had some conversations with both of them about kind of this method and the logic for it, and it really does boil down to lower time frame dynamics and what we can observe from that on the daily chart. Okay, we're also going to look at the idea of institutional order flow. So there was a small lesson we did on that, but essentially the idea of institutional order flow looks at which PD arrays are being respected, which are being violated. And remember, this has to do with order blocks and chain of state deliveries, right? So we're going to be looking at that as well. That's going to be on our higher time frame. So as we approach these three concepts on the higher time frame, they will be building on each other, right? We're going to use all of these three high time frame ideas in conjunction to create kind of a daily bias using just one chart, the daily chart. Then we're going to redact some of that information from the daily chart, and we're going to put it into our intermediate time frames. And on the intermediate time frames, we're going to be looking at very similar concepts. We're going to be looking at structure, usually in the form of a market maker model. And we're also going to be looking on the intermediate time frames at correlated assets. And this is going to be the idea also of SMT divergences, right? Which is relative strength, weakness. And then on the intermediate time frame, the other thing we're going to be considered, in addition to the structure argument, is going to be, sorry, I have a really, really bad mosquito bite. If you see me bending over, I'm itching my leg. We're also going to be looking at profiling. And this is going to be our intraday, or we can actually now better define this as protraction profiles. And on the higher time frame, we're also going to be using the idea of profiling, which is going to be our weekly profiles. Okay, so lots of concepts here, which we're going to be talking about to define a daily bias. And really, the hardest part of trading truly comes down to understanding narrative. And narrative is just simply whether the daily candle should deliver to the buy side, should deliver to the sell side, or it may consolidate. So understanding those dynamics of the daily candle is really going to help us. I'm going to put my Discord screen on my monitors. If you guys have any questions, you can also ask me there. Okay, so without any further ado, let's hop right in to kind of some of these concepts and how we're going to approach utilizing them for daily bias selection. So as always, we'll start this conversation on the daily chart. And let's use this last week as a case study and work through each day to determine what the daily bias is and what we would have selected given these concepts. Okay, so we'll start in the higher time frame, and let's start with using the bar replay mode, and we'll go from Monday onwards. This is a bank holiday as well, so it's an interesting case study because it was a shorter week as well. Okay, so on Friday of last week, the first thing we want to look at is the idea of the relationship between internal and external range liquidity. Now, as we understand on this chart specifically, we're trading at the all-time highs on NASDAQ, so the idea of targeting, buy-side liquidity, right, on that rests, on the other side of the curve might not be as applicable, in which case we will need to use some of the other concepts that we see on this higher time frame. So let's start, first of all, by looking at where we are coming from on this daily chart. As you can see, on this Friday, we have traded into this daily buy-side imbalance, sell-side inefficiency with an SMT divergence. So you can see that in here, we form an SMT in this internal range of liquidity. Now, you want to solidify that, so let me reload this so I can show you the chart for the ES to prove that we form that divergence inside of that PD array. Right? That's going to be right in here. So as we notice, coming into the week, which starts on Monday and ends on Friday with a bank holiday in between, we have formed a PD array divergence, right, inside of an internal range of liquidity. Naturally then, the next draw on liquidity is going to become the external range. Utilizing our correlated intermarket analysis, we can now draw out the swing high for both the ES and the NASDAQ. So this swing high in here is going to be the draw on institutional liquidity, utilizing the idea of internal to external range liquidity. This is where we use multiple arguments, right, for a bias for the next day. And again, we don't know how this Monday candle will print as of yet. All we can see is this. This is our chart view on this higher time frame. This is where we now integrate another concept for daily bias selection, which is candle body closures versus sweeps. So in theory, we have the first concept we can understand well, which is the idea of trading from this internal range, fair value gap, right, to the external range high, which is yet to be liquidated on the ES. You can see that we have another SMT at the highs. Now, which SMT is obviously going to be more pertinent, like I've taught you, is going to be this SMT that aligns with order flow in the market, right? We are bullish in order flow, so we want to see these divergences at the lows and still expect price to reach into that external range high. Specifically, we're trading at all-time highs, right? There's nothing to look left for. So the idea of candle body closures versus wicks is simple. Our argument becomes, this is for topic 2. I don't know why I got rid of my text box. If the daily candle closes above the previous day high, we anticipate the next day will target the previous day high. So if this daily candle closes above the previous daily high, we anticipate that the next day will target that day's high. And you can see that kind of analysis is pretty straightforward and also quite robust in terms of trending markets, right? You can see we close above this previous day high, and so the next day we close above that previous day high. We close above this previous day high the next day, and so the next day we trade into the previous day high. Now that is why we're going to use the idea of closures versus wicks in the next argument, because the next argument becomes if the daily and this is the same with the low as well, right? Same argument for previous day low. There's no difference for the argument for previous day low. It's the exact same, right? So we can show an example of that here. If we close below the previous day low, the next institutional draw becomes that day's low. Likewise, if we close below that day's low, the next institutional draw becomes the previous day's low. And now we have a unique edge case where if the daily candle does not close above the previous day high or previous day low, we expect the next day, right, to reverse back into the range, potentially targeting the other side. So what do I mean by that? Right? That's a large statement, so let me break that down. If the daily candle fails to close above the previous day high or the previous day low, we have two unique expectations on the draw for that next day. The first is that it could reverse back into the range, trade internal. The second is that we may potentially put in a reversal and target the other side of the range. So what does that look like? Let's use the same example I used before. We closed through the previous day low on the Wednesday, so the draw for the next day becomes that Wednesday low, which is again closed through. So the draw becomes that Thursday low. In this case, you can see we wick below this low, but we fail to close below that previous day low. Failing to close below that previous day low is going to signify for us that there has been an institutional point of resist or support, I guess in this case, inside of whatever inefficiencies, PD arrays, or elements that exist at that previous day low, which is why we don't use this concept in isolation, right? We're now going to pair concept 2 with concept 1. What do we notice about this previous day low? Well, you can see that as we trade into it, we're also trading into an internal range of liquidity. Interesting. This is also a higher time frame weekly fair value gap. Very interesting. So now we're utilizing two concepts in complement of each other on just these higher time frame charts. One is that we fail to close below the previous day low. So immediately we are thinking that we may want to target internal to this candle, or in this case, the previous day high. Likewise, we have traded into our internal range on the weekly. And now we can start to utilize that bias to say, well, the draw on liquidity might become now this external range on the weekly. Now we're using complementary, right, techniques. We're utilizing two of our daily bias tools together. Fantastic. The next day you can see we close, right, below the previous day low, meaning we can now say that this next day we can expect to return into the range of this candle or potentially the low. Now, do you guys think that we would come into this low or come into the range of this candle? I'm going to mark out an area of this candle, maybe like the 50% of it, for example. Right? Even of this wick could be interesting. Now, why do you guys think that price did not return back into the low of this candle despite failing to close above this high, but instead came back into the consequent encroachment of that previous day wick? It has something to do with this first topic. Someone give me an idea. Assuming it's somewhere in the 0.5 standard deviation of low risk entry, yes, this could offer a low risk entry on a lower time frame. Good point. What else? Higher time frame is bullish, yes, because this is a weekly array. I really like that. We tagged the, yeah. Okay, so two responses by Fabi and by Luca for that higher time frame bullish thesis. Yes, okay, it's a liquidity purge, and then we're returning back into the range for offset pairing. There's also the idea now of this third higher time frame daily bias tool, which is going to be institutional order flow. Which PD arrays are being respected? As you can see, we have this inversion. We have this SIBI in the market, this daily SIBI, right? What happens is that price trades into the previous day high, into the daily SIBI, and mitigates it, right? Now look at what happens on the ES. The ES trades through that imbalance with a candle body closure through that volume imbalance, and also, right, an inversion of the fair value gap itself. So we're using all three of our tools, right? Institutional order flow, higher time frame array, we're using candle body closures and sweeps, and we're using IRL, ERL to say that this candle, right, although it doesn't close above this candle's high, right, it's very unlikely that price is going to come all the way back into the low. We're seeing the bullish reversal on ES, right, closing through institutional order flow. Which PDRAs are being respected? Well, this daily SIBI is not being respected on the ES, right, and we're using SMT divergences. And in this case, we're seeing that PD array here has been completely invalidated on the ES. Then we have the higher time frame IRL to higher time frame ERL. And now we can say that it's likely that this candle, as opposed to maybe trading into the low, would trade inside the range, right? Remember, that's our second condition. If the daily candle does not close above the high or the low the previous day, we can expect reversal back into the range, or the other side. It's both. It's one of the two, right? And in this case, we would not expect to see price trade all the way down to the low. That would not make sense. But look at how beautiful the consequent encroachment level of the previous day wick is respected, which we'll eventually get to on the lower time frame, is going to be some more arguments of interest, which we'll discuss, right? We'll be talking a bit about structure, divergences, protraction profiles, but let's just stay on our daily chart for now and keep continuing with the exercise. So now, as you notice, this day trades into this previous candle's wick, and where does it close? It closes internal to the range. So we don't really have, right, a good read based on this first idea of where the candle body closed, because you can see it closed inside of this range. Someone tell me, let's go bar by bar. Someone tell me if they think that we're more likely to come into the previous day high or the previous day low. What do we think? And why? Using these three concepts. Remember, the second concept here is not telling us much because we're internal to the range. So let's use this institutional order flow argument and this IRL to ERL. And let's see if we get a better argument. The more you comment, the better. Let's get as active as possible. Previous day high, because even if we trace, there's still an FVG above. I love that answer, Fabi. Yes, I have yet to draw it in because I wanted to see if anyone mentioned that we have a premium array. So which argument does that align to, Fabi? Which argument of those three tools we use on the higher time frame? Which one is that? Is it IRL, ERL, candle body closures, or institutional order flow? Previous day high, there's an FVG above. I really like that. That's the answer I would have said too. I also would say there's an argument of IRL to ERL. Look, we have relative equal highs. Do you see that? The daily chart, if we go down a time frame, which is cheating, but you can see we have these relative equal highs, and above them is going to rest our sell side imbalance, buy side inefficiency, a premium array. Remember, this is institutional order flow. Which PDRs are being respected, which are being violated, right? Another way we can say that is what PD arrays, which PD arrays are the DOL, right? Was price drawing into a specific PD array on this higher time frame. Yeah, it's the institutional order flow, absolutely. Also, what about the weekly profile argument? Someone tell me the weekly profile argument here. This is a Tuesday that's put internal to the range. Remember, on the Friday, we formed an SMT divergence that looks like this, okay? And we can see it on our chart. Okay, so Friday, we formed an SMT divergence. Monday, we traded into, again, not a random point, but we traded into a discount of this Friday's wick. Okay, So could this potentially be a Monday low of the week? Yes, I like how Jimmy said ES is strength. Absolutely agree with that one. This could also be a Monday low of the week, Tuesday consolidation. What's the higher time frame draw? ERL on the weekly. Cool. So we have that argument. We have a premium array for the argument of the institutional order flow. And now if it's a Wednesday, we could get expansion because Monday low of the week. So we'd have open, low, and now we're in what part of this weekly candle? Potentially we're right here. We're in that first phase reaccumulation for another expansion because a small range of consolidation, this looks like a small range, this inside bar, right? Is it more likely to reach lower into here, or is it more likely to reach higher into here? We can use the argument of weekly profiles to say we want to see a Monday low of the week, which means Tuesday, Wednesday, and Thursday should expand. Friday could close back in the range. Wouldn't reaction from 2 bearish order blocks be considered bearish? But what is being, so again, from the institutional order flow perspective, what is happening on the weekly time frame? The highest time frame chart. We've tagged a weekly internal range of liquidity, right, with SMT. So again, we should also include the idea of SMT divergences in here. So we have a weekly higher time frame inefficiency, buy side imbalance, sell side inefficiency. And then in addition to that weekly imbalance, we have the SMT. And now we've created a range. We also have a premium daily array above us. And right? We've created this Monday's range and we put in equal highs. Oh, stream quality looks better? That's awesome. Yeah, I think it was Discord last week. So I'm going to say that based on all of the arguments here, right? Let's just talk about the higher time frame for now. Okay, we can do all this in our daily and our weekly charts. We have arguments to go long in the market, targeting external range liquidity and this fair value gap. So even if we wanted to trade lower, right? So Ash, say for example, price wants to trade lower. Look at the premium discount of this market. I would like to see price potentially reach up in to this optimal trade entry, which overlaps this daily SIBI and this premium part of the order block. So even if price wants to do this, that's fine. But I see that putting in equal highs that rest below this inefficiency give me a nice draw for the next day to be higher. Remember, we're just looking at the highest time frames. On the lower time frames, we're also going to see structure, protraction profiles, etc. But on this highest time frame chart, we can see that this internal range on the weekly is being well respected, right? Look at the 4 hour, for example, out of this weekly PD array to this nice original consolidation. This is what the intermediate time frame looks like. But I'm going to train your eye to just start looking at the daily time frame as well, because the daily time frame is one of the most underrated and underutilized time frame charts. I find that a lot. When I started trading, I didn't use the daily time frame as much as I should have. Okay, so now we expect the next day to expand higher. If it's a class expansion, we expect Tuesday low of the week. Monday can also form low of the week on a classic buy week. So a classic buy week looks like something like this. Opening, low, high, close. And this low can form on Monday or Tuesday. It all depends on when the array of interest is met. So you can see that the array that we were looking for to frame a reversal, this weekly inefficiency, was actually tagged on the Friday, and then Monday traded into the wick of that Friday. So we can expect Monday low of the week, right? We also had that large SMT that we cared about inside of that previous week's low. So now let's say the next day is going to expand higher. Boom. We get this large Wednesday expansion into our external range high. Fantastic. The weekly chart has now gone internal to external, very simply. So now let's look, right? Did that answer your question, by the way, Tom? Yeah, the Monday low doesn't need to be swept here because it comes into this premium of this, a discount of this wick, and then Tuesday gives this retracement lower. Again, the reason why it might not sweep this low is because the intramarket analysis. Look, ES closes so bullishly through that gap Then we get a deep retracement. This is a down close candle on the ES, right? And we put in again relative equal highs, right? And here you can see we have more of these relative equal highs, and then ES also has its draw up here. So I would have said that Wednesday is a nice long candidate to reach in to at least this gap, but also this weekly high. Again, we're not even using the economic calendar here or anything. We're just looking at the daily candles, which is so important. Okay, the next day, let's do it. Do we think that the next day is going to go higher? Would you look for a discount of wick? Yeah, on a doji, for example, I would be looking for price to trade. So if we ever form a large doji like this, I'll be looking at the quartiles of this wick, for example, and looking to see if we can trade into premiums of these large, or discounts of these large wicks. Yeah, because that on a lower time frame is going to look like this: open, low, high, close, right here. And the whole weekly candle is going open, low, high, close. So every day is going to be engaging some discount array in these expansions. Okay, so the next day, let's now look at what we want to see price do. IRL to ERL. Well, we have closed above internal range, and we've yet to create a new fair value gap below us on the Wednesday, right? What has happened here now? There's no higher draw. We're at all-time highs. So we can't say that price is seeking a new high that's going to run out old liquidity. What we have to use is the idea of candle body closures, okay? So this candle closes above or below this wick. Well, this here is a break of structure. Where is my break of structure? There we go. We break structure higher, right? So now what we're considering is simply longs into this candle high. So now we're looking for because we closed to the previous candle high, because we broke structure here, we're now seeing if we can close into this previous day high. Now for me, because the weekly objective will be met, what I would anticipate to see right here is something that looks like this. This next day to reach into this previous daily high and then come back into the range. Alternatively, we also have this order block. Right? We could see the next day trade into this low and then to the previous day high. So there's two options. Either we trade higher than lower or lower than higher. Both ways, I want to see this previous day high taken and see how we react to that using just the higher time frame chart. The weekly profile is now showing me two possible outcomes. Open, low, high, and now we're going to form this close, which would look like this, right? Taking out that high, closing into the range. Or we're going to keep expanding, form, another higher high, and then close. So that would look like this. Both ways, I now have a daily bias, which is going to be just long into this high and then seeing if we come back into the range. Alternatively, if we come lower first, I'll be looking to trade higher. Okay, so we've got that first scenario, right? You can look at the lower time frames. We come into that daily high and then come back into the range, right? So now we're expecting not to see a big price move today because we had that large, expansive move on Wednesday. Now we can utilize the concepts that we have drawn out here. Where does this candle close in relation to the previous day high? Above or below it? Would you still be considering long if the previous day high is taken before coming back into the range? No. So if we took the previous day high, right, like we did here, right at open, the market closed at 4 p.m. and then we traded above it in the Asian session. Now I'm looking for us to come back into where? This order block, right? This is now my daily draw on liquidity because you've already expanded and I'm using the concept of external range back into the range. So this Thursday puts in a consolidation and now I'm either expecting this day to trade lower than higher and then we'll keep going higher, or trade higher than lower. It's giving me an indication that price is going to either purge, then consolidate, or, right, manipulate, then expand. I have to see how this daily candle reacts. And because we got that purge first, then that consolidation, now I can use all my concepts on the next day. So look at all the concepts I can use now. I can say we fail to close above that previous day high, which I have marked out here already with an indicator for you guys. We fail to close above that previous day high. I have this order block, and what else have I created in this price leg? Someone tell me. That has to do with these things that we're looking for. Nice. Yeah, when this previous day high is taken on Thursday, we're looking to see if we can get arguments back into the range. Yeah, I would be looking to trade short back into the range once I saw that previous day high taken, because I would not be expecting expansion without first offering some discount of this range, right? Because we had a large expansion, I'm now looking for some discount of this range, or at least this candle, because I know on the lower time frames, there's gonna be lots of inefficiency in here. So if price keeps expanding, I won't get offered any long opportunities because I need to see a retracement. As you guys know, it's a part of my trading model, right? I need to see some sort of, imbalance like that be traded into before I can go long. So if there was an opportunity this day, it would be taking out the previous day high, then getting some shift lower, and then again, I need some sort of higher time frame array. As you can see on this case, in this day, there was no arrays offered because we consolidated all day. Good. There's no trades offered on this day. It's just a low probability trading day. No PD arrays are offered. So now, going back to my daily charts, everyone's had the right answer there. We had a daily BISI created. So in the creation of this daily imbalance, right, I will now draw that out. Once we've created this daily imbalance, I now can use, again, my higher time frame tools to say, I expect price, which closed below previous day high, to now come and maybe trade in to this previous day low. Why do I want that previous day low? Well, overlapping that previous day low is my imbalance, my order block, and my area of interest in the form of a fair value gap. So my draw on liquidity for the day is going to be this order block. So if I can look to trade short into there, I now can use lower time frames with this daily bias. Perfect. See that? The next day, right, into the order block, fantastic. Here there'd be a trade opportunity. And again, you can see we sweep the previous day high, and then we come right into that nice previous day low like we wanted to see. So you can see the power of just the daily chart here, because the lower time frames are going to be trade opportunities and stories about price delivery, but these higher time frames are telling you points of interest that you can frame lower time frame trades around. So on the Friday, you can see we come back in at news to this previous day high, sweep out all the highs, and then we trade lower. So in that day, there was an opportunity for me to trade long out of my daily order block. Would that green candle overlapping the OB be called a breaker? Yeah, of course, right? This right here is the breaker. So we have multiple overlapping PD arrays. So on this day, because I now have an area of interest, I'm able to frame a trade when we come into here. So when we come into this area of interest right in here, I'm able to look long without needing, for example, to see an hourly chart confirmation, because I already know I'm going to have my hourly imbalance in here that I'm trading the 5-minute chart off of, like that. That's my hourly imbalance. But I have the narrative based on the daily candle closures and my expectation for the next day, right, to now drop down to a lower time frame and be able to offer myself an entry in here. So once I see, for example, something like this, we trade lower, we start to accumulate, and then we get this inversion fair value gap and balanced price range, right? Bullish fair value gap, bearish fair value gap. If you want, you can use the idea of premium discount, and you can enter as soon as we come back into this 5-minute FVG. I remember this day because it was a double purge theory, which is the last lecture I talked to you guys about, which is, right, buy stops 1, sell stops 2, and then we run into that high, right? I remember this day very clearly. We traded it live on stream. But here, for example, you get your trade opportunity from this fair value gap, targeting the data highs, risking here, right? Perfect trade. And it's all based off that previous day candle close and the narrative we had from that close. So let's keep going and keep doing the exercise. As you'll notice, all you have to do to convince yourself this stuff works is show yourself, right, through repetition of this daily chart, right, not even going down yet, just staying on the daily chart, that these concepts really work. So now, where does this candle close in relation to the previous day low? Everyone tell me. Close above or below it? Above. Everyone above, above, above. Everyone can see it? Cool. So where do you want to target? Previous day high. Nice. Yeah, I would actually agree with that. I would say we're either going to trade on this on Monday, right? It's Monday, so we might consolidate inside the range. But the next draw on liquidity is going to be here for me, right? Previous day high or back into this candle's range. One of the two. We're also coming off my daily order block, which was my key level. So I have lots of confluence for the next day to be an expansion, right? Maybe not into the previous day high. Why? It's Monday, right? Weekly profiles. Mondays usually don't expand, but if they come into a daily array, you can definitely look for a long trade in here, right? Then again, your work is done for you on that daily chart. On the hourly chart on the Monday, all you gotta do is look for something. So what do we see? Let's see, the session opens right here at 9. Do we have any SMT divergences that we can use to qualify a trade? Boom, there we go. Here's our SMT divergence at the previous day low. Oh, it doesn't actually come, it's right here. Whoops, right here. There we go. SMT divergence with the Dow. Comes in below, creates a higher high, and then we can look for a trade somewhere in this hourly charts. I'm not going to do trade breakdowns, right? But you guys know what I mean. You know what you're looking for. You have a good daily bias. You know to reach up into the range is what you want to do because of your daily candle closures. Fantastic. You guys take a winning trade that day. What's the draw for the next day, guys? My students are going to know this is a what? Well, based on last week's lecture, guys, what is this? Someone tell me. One of my students. Next day model, yep. So this is now combining that next day model with daily bias, which is obviously what you're gonna do, right? This is the next day model. So where's the draw on liquidity? All my students should be able to tell me where the draw on liquidity is without even second guessing. The obvious, most likely candidate for us to reach into is all-time highs, yeah, previous day high. Perfect swing point put in, 3 candle pattern. The next day model is something I taught my students last week. So we all know we should reach into this high. Perfect. No one's surprised by that, right? That's expected. And look how we trade. Look into what area of this previous daily candle we trade. Remember, you can go down to lower time frames and lose yourself. But look at where on this daily candle we trade into. Look at that. Right? You can do all of this on the daily chart. Look where we trade into. The wick of this previous day's sell side wick. Why? Because that's a lower time frame fair value gap. Do you see it? Lower time frame FVG right in here. So when you get these daily levels in confluence with your daily bias, then when you hop down to lower time frame charts, it'll all start to make more sense. One of the most transformative things in my trading was to actually start utilizing the daily chart a lot more than I currently used to. I used to use it almost never. I used to use daily chart when we came into a daily fair value gap, but there's so much more, right? There's so much more context, right? Let's look about institutional order flow. Did we respect this order block? Yes or no? Someone tell me. Was this down close candle respected? Yes. Better, no, it wasn't respected, Talon. We didn't respect these down close candles. Yeah, we traded into it to the tick, right? And we closed above it. So closing above the order block is one thing. There's another thing we can look at, right, on this daily chart. This down close candle in here, right, is an order block as well because it sweeps liquidity, trades lower than higher than lower, right? As you can see, as we trade into this wick as well, look at the levels. Here are the order block. 19,917.25. And the low of that day was 19,195.25. A 2-point differential. This is narrative that we can get saying what candles are being respected. Well, we're respecting the breaker, the order block, this wick, the daily fair value gap. We're closing above the previous day low, and we have a next day model. Obvious draw is going to be previous day high. In your head, immediately high probability day to trade. And this is where you can hold. You can hold for this whole move, right? You can get in here, somewhere involved. Let's break the trade down. And you're expecting not just to target this high, but to close above the high, right? Remember, you're bullish. Remember, if you're bullish on the day, do you want to close above the high or wick above it? Someone tell me. If you're bullish on this day, do you want to close above that high or wick above it? Everyone should tell me. Close, 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 close. There we go. So are you going to take your position entirely off when it comes above this high? No, because you've just convinced yourself using about 6 arguments on the daily chart alone. We're not even looking at the lower time frame structure. The daily chart alone is giving you 6 arguments to hold past the previous day high. Fantastic. Look at the trade opportunity and the ability to trust your analysis on the lower time frames. Hop down to a 5-minute chart, right? So you can see on this Tuesday, we're going to come into the FVG. Let's mark out that FVG we talked about. I won't do this every day, but I'll do it for this day because this is a really clear day, right? We come into this hourly imbalance. Let's look for our SMT inside of this imbalance, which we will most definitely get. I gotta zoom out so I can find it. There we go. Here's the imbalance. Here's the SMT divergence with the Dow. We might be going with the ES as well. Yep, with the ES as well. Right. Cool. There's your SMT divergence. There's your PD array. This is your protected low. All you have to do now is align yourself with the order flow. Here's an inverse fair value gap, a balanced price range. There's definitely an SMT inside of this FVG as well, which is where you get involved. Now, I already know there's going to be an SMT in here based on the way this third candle prints that wick, but I can prove it to you and find it. There you go, right here. So when this comes in right there, I don't know if it's up also on the ES. Yep, right there. So on the Dow, it's this gap that's formed in that price leg, and then NASDAQ just creates it, so you can get involved anywhere in here. Anywhere. You can get involved in any of these candles. So you get involved in that one that forms a divergence eventually. Right, all you want to do is you want to target beyond the high. You can, obviously, you're going to take contracts off here, obviously. But you can hold. Because of your daily bias, you can now hold to something like this. Because a lot of times, you'll find yourself taking off all your contracts there, but now you feel the need and you're comfortable to hold all the way to maybe this second standard deviation. Let's see if price offers it. So it comes, let's extend these lines right. So at the end of the day, you're going to close right out here, obviously, because you're not going to hold past the next day. But yeah, you can hold your position well into this. Eventually, it'll come up all the way to here, like the next day. We'll see that. But yeah, it gives you the trust to start holding your trades because you're using your daily bias. And the daily chart's the most powerful chart, especially when it comes to us and how we trade. The daily chart's going to be the most powerful chart. Okay, I spoiled it. Sorry. Gonna go back. What's happening this next day, guys? Again, higher or lower? Everyone tell me in chat, higher or lower? Higher, right? Closing above the previous day high, wicking down into the wick of this candle and closing with displacement above the high. Now again, this draw on liquidity, the reason why we can expand higher as opposed to this day where we close back in the range is because look, we just came out of this consolidation. You guys can see it on the daily chart. Here, why do you think that, what's the difference between this candle, right, on Wednesday of this week, putting in this tiny doji on Thursday, and this Tuesday expected to produce another up close bullish candle like this? It's simple. It's the daily market profile. The daily market profile here went from consolidation, manipulation, so A, M, D, A, right? M into the daily fair value gap. We can distribute higher. This next candle is not like this candle here, which already distributed into what? Buy stops. No, this here can go, and it should go. Remember, this day is Wednesday, capping the weekly range. This here is a Tuesday. So what kind of week could this be again, guys? What kind of week are you thinking? Now we're using the fourth argument, weekly profile. Classic, yeah, everyone should be able to tell me what kind of week this might look like. Very similar to this week. Classic expansion. So Tuesday, Wednesday, and maybe even Thursday can expand. We're thinking opening low, and we're just now getting this. So we still have 1, 2, 3 days, right? Tuesday, Wednesday, Thursday, Friday. OHLC. So we can anticipate another expansive day, not for us to come back into the range. How do you decide which of the previous candles with wicks to use for retracement? I look for any discount of the wick. So on the daily chart, for example, I would not anticipate price to come back into this wick because we've now closed above this candle. I would now look for this previous day high to be retested in addition to what? This order block, right? So here is the key level. I would like to see price form an open, low, high, close, right? And the next day, we don't even get any retracement. So you can see we're just straight bullish the whole day. So would there be a chance to get involved in this day? Let's see. Again, we have a bullish bias, so we want to see this previous day high taken. And you can see that by the time we open, we're already trading well above it, and there's almost no retracement, which again is an indication of extreme bullish order flow. I think it was a news event. Yeah, it's CPI this day. So as you can see, CPI barely offers any manipulation of that daily candle, almost nothing, and then just rockets higher. So the only opportunity to get involved is in the PM session like we did with FOMC, right? FOMC comes into this gap and then we target this high. But yeah, this is a tough day to trade because there's no retracement of the daily candle offered. It was just a bullet, like it literally just went higher and higher. Okay, now, we now have this Wednesday closing above this high. Now what am I thinking? Because I just said it. You just heard me say it. We've offered zero discount in this range, and what have we produced in this range? An inefficiency in the market, a new daily BISI, and we've had 1, 2, 3 expansion days now. I'm now looking for my daily bias using the daily chart to either take this high and do something like we saw last week, right? Take the high, come back into the range, or trade lower and then take the high. One of the two. It's going to do one of these two things, right? So now we have a bias for the next day. Do we think the next day is going to offer some crazy explosive move? No, because we have this large expansion, right? No retracement of any of this range yet. So we're not going to say the next day should go like that. It wouldn't make it. We would not want to see another candle go like that, or else we wouldn't trade it. We'd want to either see this or we'd want to see this. One of the two. Both ways we can trade it. We either trade it long from the inefficiency or short into our inefficiency. This is how we use a daily profile. Because you can see this candle here offers what? Discount. It comes back into this area and trades below. It has an open, low, high, close. The next day just has an open, high, close. Not even a close. It really just looks like this. So now the next day we don't expect to also do this. The market generally doesn't move like this, right? It moves like this. Right? Open, low, high, close. Open, low, high, close. This is just open, high, open, high. We wouldn't want to see that again. So now we have a good daily bias. And our daily bias is going to be to see how we react to this previous day high and either trade short into the range, right? Or trade from the range to the high. One of the two. Let's see what happens. Do you guys see what you're doing? What did you just predict with me? What did we just predict that next day would do? Starts with a C. Just from the daily chart, nothing else. What do we predict this daily candle would do? Consolidate. How powerful is that, by the way? Most people cannot say that they can anticipate a consolidation to form. But you can, based on just these 4 concepts. The weekly profile, expanding Tuesday, Wednesday, right? Not offering discount. So what is that? Institutional order flow. We have not offered discount of the range, right? IRL to ERL. We've taken out all of the buy stops and we failed to offer any sort of retracement. The next day, of course, you don't want to just blindly long and anticipate another candle like this. There you go. Powerful stuff for a lot of people who would get chopped up in this. Is there even a trade? Let's see. Well, this looks a lot like this. This in here looks very identical to this in here. And you are learning just through the daily chart how to anticipate these days. Look, large range move, this shit. Large range move, this shit. Both on Thursdays, coincidentally. right? Same exact weekly profile 2 weeks in a row. Look. Internal, expansion Thursday, caps the range. Internal, expansion Wednesday, Thursday, Friday, caps the range. 2 identical weeks of price delivery. So let's see if there's a trade in here that we could have taken understanding that. I think there's a nice trade in here, right? Yeah, spotting low probability is more than half the battle, more than half the battle. So the New York session opens at 8 a.m. Well, as you can see, at 8 a.m., we have a beautiful opportunity to get involved in price lower. Beautiful. Because what have we done? We have traded above the previous day high and then started to wick below it. You can see that. By 5 a.m., right, you can see that this candle is coming back into the range of the previous day high, leaving what? Imbalance. Buy side imbalance, sell side imbalance, buy side inefficiency. No worries, boss. I'll upload the rest of the recording. Yep, I'll upload it later. Sell side imbalance, buy side inefficiency. Look at the respect of this PD array, correct? What else have we done? Shifted delivery state. Look, up close candles into this area. Yes, nice. Change in the state of delivery. Nicardo said it perfectly, right? Now all we have to do is look for what up here. What do you think is going to happen up here? Starts with S. SMT. There you go. Right? Let's find it. Prove to yourself these things really work. Prove to yourself that I'm not just saying these things and they truly work. There's your SMT, right? Previous day high in here. So we have this SMT. Right there. Wednesday high. Fails to reach into Wednesday high. Let's look at the ES. ES and the YM, right? Or ES and the NASDAQ both reach into the previous day high. The YM does not. There you go. There's your SMT that you want to see right up in here. Perfect. Cool. I can now look for shorts because this qualifies a reversal. It looks like that, right? I have my point of interest. Now all I got to do, so I'm just going to keep my SMT like that so I don't have to draw it awkwardly. I'm going to go down to my lower time frame, right? 5-minute chart. Wait for the kill zone to open. Let's turn on my New York kill zone. Right, wait for the kill zone. Come up here, sweep London highs, start to displace. I'm not getting involved. I'm not going long, right? I don't want to long until, look what we're leaving. It's beautiful. We're leaving these Asian lows. It's beautiful. I'm also on the wrong contract here, I think. I think now is when I should roll my contract. Or this should be NQM. Let me actually do that. Actually, no, because I don't want to lose all my markups. Whatever, it's fine. Okay, I have these nice Asian lows, my consolidated draw on liquidity. All right, we come up into here. Let's look for a lower time frame SMT as well. Let's look at the ES. It's so choppy because of the contract rollover, my bad. I want to look for a lower SMT inside of my FVG. I want to see if this fair value gap is traded into with SMT. Yep, it's right here. Perfect. Cool. There's my SMT. And there's the trade option, right? All I gotta do is wait for it. So there's SMT with the YM, and then we finally get that breakdown, right? So we have our hourly PD array, our 5-minute SIBI. Once we have the 5-minute SIBI with the SMT, right? We know we have our draw on liquidity is gonna be lower into what? Go to the hourly chart, right? We have this huge range to fill in, 4-hour imbalance to fill in. Again, we're expecting a choppy day because of the conditions. So what I would do is I'd just say, from here, I want to see price maybe trade into these lows. I wonder if we put an SMT at the lows. It's kind of hard because the contract rollover I can't see. Oh yeah, we definitely do. Right? It's hard to see because the contract rollover, but anyways, there's a trade in here that you can take using the idea of our daily bias, right? Maybe we just use projection, for example. Okay, I want to trade into like 1 standard deviation of this leg. Actually, let's use this leg in here before the news. There you go, 2.5. That's good. Is that exact? Yeah, there you go. I would like that 2 level to be traded into. So come into here, go short, stop loss at the highs, and then target this. Let's go 2R. Let's go here and then actually make it a 2R trade. Yeah, it's a nice trade. Anyways, for a choppy day, nice trade. Again, utilizing daily bias only. Only the daily charts we're utilizing so far, which is really awesome that we're able to pretty much 80 to 90% of the time, we know where the price is going to go and what direction we want to trade, which most people cannot do. Most people cannot answer that question of what is the daily bias and what direction do you want to trade on, right? Because if you can answer that, you're going to have a lot of success. Okay, what's next? Let's do the next day quickly. What do you guys think for the next day? What do we create? Lower or higher? Someone tell me. Well, where does this previous candle close in relation to the previous day high? Everyone tell me lower or higher based on what we've been talking about in the lesson. Nice. Awesome. Okay, lower. It's pretty obvious. What kind of gap is this, everyone? My students, actually everyone knows. Everyone knows because I have a lesson on this. What kind of gap is this? Breakaway, breakaway. Why is it a breakaway? Yeah. Higher FVG, third candle consolidates. If price reached all the way into this low, I'd be surprised. So do you think that if I'm short, I'm going to target this low? Absolutely not. Yeah, absolutely not. I might be targeting here. Like just, if I'm trading short the next day, it's into this array. That's it. I'm not trading past this array. There's no chance I'm trading into that fair value gap. So for me, this fair value gap is a breakaway gap because there's no chance I'm ever targeting it with my analysis the next day, ever. And there you go. We form SMT inside the gap. Right? So the price comes in. And this is where we were before we started the lecture. Price forms at, and we're looking to trade. So when we come to the charts the next day, we're saying we want to go lower into this gap. Then we don't know what could happen from this gap. We could go higher, or we could stay in the gap. But our thesis is, like we knew from this day close, we want to attack what? Previous day low, right? Previous day low, rests directly above the gap. That's where we form the SMT. As you guys know, an SMT is the same thing as a liquidity sweep, so we're good. Let's see how the lower time frame dynamics printed and what trade we would have taken. So again, we're targeting that gap. When does the session open? London. Okay, perfect. So you would never trade short this day because by the time we come into the day, we've already formed the SMT. Perfect. So what direction would you trade into the New York session, guys, seeing this? So you come to the charts, and it looks like this. This is what your chart looks like. What direction are you trading? Everyone's trading long, right? No one's trading short after we sell that SMT. Hopefully. Right? We accomplished the goal. We want to see that previous day low revisited. Absolutely, it was on the ES, previous day low, SMT divergence. Now we want to target what? Maybe these highs. Right? This is the draw on liquidity. It's a pretty easy trade this day as well. Again, just using the daily chart. And there you go. Another winning trade, another winning day, just using the daily chart bias. And then it explodes, right? Wait, we got ahead of ourselves. Okay, next day. Long or short, guys? You didn't see that. And even if you did, you have to tell me why we're going long. Why is the next day long? Close above, long, nice. Also, what other concept? Institutional order flow. Which PD rays are being respected? Daily BISI. Daily BISI was just traded into. That's a respect of that imbalance, right? We've offered this candle body high and we've closed above the external range of liquidity. So price consolidated, manipulated, expands. It's different than this day, isn't it? Why is this next day, that obviously we can say is going to expand, look not like this day here on Thursday or this day here on Thursday? Why are we not getting these dojis? Because look at the price delivery, right? Do you see the price delivery? We're getting expansion into accumulation, into manipulation, and then we're just like that. Price is allowed to expand from there, right? Right now, all that you have on this candle close is this. This is what the chart looks like on a lower time frame. Don't believe me? Let's look. It looks just like this on a 50-minute chart, okay? Look at this in your head. Now look at the 50-minute chart. Right? We have expansion, accumulation, manipulation, and so we've done that. Expansion, accumulation, manipulation, SMT, and now we're just sitting here. Price can make a leg higher, so we're not expecting it to sweep the low and close back down. We're expecting to rip because this is going to be a two-stage move, right? Accumulation, manipulation, right? Distribution. So now we have the bias to go long that day, just looking at the previous day candle close and what this candle was. It was a doji, we manipulated, we formed SMT, the next day should be a moon. Right? And there it is, the moon. Where do we come back into? Previous day high. My students know this as another lesson I taught, which is referring back to the previous day high, right? So what's that lecture called? Do you remember it? This one was a while ago. Willie made a PDF. It's called Daily Rebalance Theory. This is a daily immediate rebalance. Now you don't need to know this, but what you do need to know is that there's this wick, right? This area where we broke structure, look at a lower time frame. That's where we come back into. Into what? A PD array in this area, right? So I remember this Monday because I got chopped out in here. Because unfortunately I entered the market a bit too early, but it is what it is, right? I entered on this sweep right here. I entered on that sweep because we had an SMT. Right, we had the SMT form like that. And I entered at this 8 a.m. candle for news. Next time I will wait until we sweep out the more obvious low. That was an error on my part. But again, come into here, into what, right? Previous day high. You can see the previous day high is right here. And look how we're closing above that, even on these hourly candles. This is our rejection block that we talked about last week, and this is your CRT or whatever the hell you want to call it, right? This is the purge and expansion. So very clear bias, right? Utilizing the same 4 principles in the daily chart. And you can see clearly where price comes into, right? It's this order block on the 4 hour or on the 1 hour. It's this imbalance in here. Very wicky, but still holding the imbalance. Right. 5-minute chart, lots of entries. So let's turn on the news. This is how I ended up taking a loss, I believe, because I traded with the news. And once we formed that low with this SMT, I got long preemptively without structure on my side. It was a bit impatient. I journaled it. It is what it is, right? So here we had the SMT form after the news. Where was it? Right there. Right there we had the SMT form. And then I was like, okay, I want to get long. Maybe I got involved right in this news candle. I don't know. I'll check my journal. But eventually we came back down. We swept. And then in here you have a really classic, just beautiful entry. Can't go wrong. Go long. And again, you're not just looking to trade into these highs because look at the daily profile. Right? We want the day to expand because we already said what part of the daily profile are we in. We had expansion, accumulation, manipulation with SMT, and now we're just sitting here. So we're not just targeting these London highs. We want to target like much higher into the range because we want to actually expand on this day. So when you get this entry here, yes, a good partial is the London highs, obviously, but this is a day where you can actually expect expansion, and then you can use something like a standard deviation projection because the daily profile is signaling expansion. And as you can see, price comes into our 4th deviation, and that forms more or less the high of the day. Now, would I hold all the way to here? Probably not. Probably hold till like here. But still, a lot of points are offered, right? And it's again coming from understanding the daily profile from just the daily chart. Okay, we'll do a couple more days, and then you guys will get the point, and then you go and back test it and prove to yourself that this higher time frame alone is all you're going to need, and then you can go down to the intermediate time frames and look at those other concepts I taught you, which you guys have access to in lectures. So next day, what can I see? Expanded through here, closed off the high. So I want to see if we can take out this high and either do this, right? Again, same protocol. Take out the high, come back into the range, because now we've had expansion, accumulation, manipulation, expansion. Now we have a dealing range in here. Whoops, sorry, wrong thing. This is a dealing range that I'm looking for retracement to. So either we're going to do this, right? This is the previous day high, and this is where we close. We're either going to take out the previous day high and then come back into the range, or we're going to come back into the range and then take out the previous day high. Both ways, my bias is built around the previous day high. Do you see that? The narrative is built on just this one level. We're either going to do this or we're going to do this. I know which one of those two things. So watch. I now have a narrative. I have a key level. I have this point right here of interest. Watch what price does. Ooh, puts in a double top at the previous day high. Look. So again, arguments still apply. Oh, this is a bank holiday. This was this week. All right. Bank holiday on Wednesday, so this Tuesday just kind of chops around. But I remember I targeted, you guys have traded news with me, I targeted that high, remember? Because it was the same logic. Now, I don't do all this on my chart in front of you guys every day because I've done it already usually coming into the session. But this is what I mean, right? You saw me on Tuesday trade into that previous day high, and goddamn did that hurt. This right here was like a major mood. This was me when that happened. It missed it by one tick. And then I got stopped at a break even. I don't know if you guys remember that. I was very this. This was my face the entire time. But daily bias was right? So now we wanted to see that, and then we wanted to see a return back into the range. This is when I'll use the concept of the dealing range, right? This to this, high. If anyone on stream knows, I was like, wow, that is so unfortunate. And then also on the hourly chart, I can see I have my devil's mark right here, right? So I have this range, and then right at the equilibrium of the dealing range, I have my devil's mark. So again, all we're doing is we're building on all the narratives together using lower time frame now. So the next day is a bank holiday. But on this day, there was a trade to be taken, right? The trade was to be taken off the opening, high, low, close. Ideally, we would have purged that high, like I wanted to see happen. But once we took it, come back into this really nice, what is this called, guys? Just Mo? Come on. We all know what this is called. LRLR, yeah, it's a total low resistance liquidity signature, right? You can totally see it. It's so obvious. Look at your eye is just immediately trained to notice that. So what did I trade? Into this high? Unfortunately, the better trade might have been into the low, but I took both if you guys remember, right? We had the SISD and then I traded into the lows because ES at the same time, remember, was ripping higher. ES did not get bearish at all. Look, it stayed above all of those London and Asian highs the entire day. But NASDAQ failed, put in a double top and then ripped lower because that fits our daily expectation for the NASDAQ, right? Okay, next day. Let me get rid of these marks. Actually, I'll keep this on my daily chart because it's interesting to see. And it's going to actually help us for the next day. Next day was a bank holiday. So what do we want to see on Thursday, guys? Higher or lower? This is really obvious now. Obviously, we should all say we're going to run out these highs and then go lower, right? Higher than lower, like double top. Huge daily imbalance created. And, again, for my most prudent students, what kind of candle is this third candle? This goes back to the FVG third candle lecture. Yep, nice. Consolidation. What is the most probable third candle for a retracement into a fair value gap? This one. Nice. Nick, you're the only one. Everyone should be hammering the chat. I know there's not many of us in here because it's a weekend, but still, should be hammering the chat. This is a likely FVG retracement, this candle. Plus, look at the narrative. Equal highs, right? So now we have order pairing of the highs to the lows. Perfect. When it closes below. Yeah. Yeah, it also, yeah, exactly. It closed below the previous candle high. Yeah. Those are all the reasons we're talking about. Look, let's build out the arguments. We have 5. We just said them all, right? IRL, ERL concept. Third candle method, consolidation, should reach into the gap. Okay, boom. Candle body closures. Closes below the previous day high. We want to see previous day low, overlapping, the devil's mark on the hourly, this daily BISI. Which PD rates are being respected? Well, right now, we're inside the range, so we only have one PD rate to draw into. That becomes a draw on liquidity. What's the weekly profile? Tuesday, Monday expands, Tuesday expands. The week has offered no what? What is the week offered? Nothing yet. No weekly wick. Think about it. The weekly wick looks like this right now. That's it. Yeah, there's no manipulation of the weekly range. This is a likely, what weekly profile is this likely to be? Everyone should say it. Wednesday, there's no trading. So this is going to be a Thursday reversal, a consolidation reversal, right? Monday expands, no manipulation offered. We have all of these imbalances to fill. What's going to happen next day? Obviously, take out the previous day high, come into the range, right? So there's opportunities to trade both those. Just on the daily chart. Just the daily chart, you're getting this information. Right? Look at the higher time frame. Beautiful. You already know by the time we open at 8 a.m., we're going lower. And I also took another losing trade here because we came into this daily gap and I traded this candle higher. And I took one partial in this candle before I got stopped out because eventually price went to come into the devil's mark, which I did not notice. So that, again, was an execution error on my part. Right? Devil's mark came into. We also came back into this range, which we talked about. This short-term dealing range. We came back into premium of that short-term dealing range. We also came into discount of the entire dealing range. Right? Fantastic. Really, really high probability short that day into our key levels, right? Now we're inside the daily fair value gap. This was Friday. What do we expect to happen? Well, let's look at the daily chart. Close below this day, right? Cool. So we can expect lower prices. Now, the problem is if we want to target this daily low, what stands in the way of this previous day low, guys? This huge wick, right? So it's interesting to mark out the key levels of this wick as well. So on a lower time frame, that's a gap, right? Because we have to consider all the arguments. Remember, higher time frame, IRL, ERL. Well, what are we in right now? Internal range liquidity. Where do we close in this internal range liquidity? Where is the key closure above? Someone tell me. CE, yep. It's not a bearish candle close. That's why I told everyone on Friday, it's not necessarily bearish, right? And that's why all day I didn't short, because we got no good short setups, and you can see the institutional order flow in the higher time frame was quite mixed. Yes, we closed through the previous day low, so what's the option? We're either going to come in and target this previous day low again, but we have to get through this roadblock, which is this entire wick, and the daily fair value gap, which we're closing above the CE for, right? Obviously, the higher time frame draws down here, but let's see what the daily candle offers, right? We close right above that, and we do take out the previous day low. Fantastic. So there's the trade, right? Now look where we close, the wick. Let's see if there's an opportunity on this Friday to trade into that low. You can see we come into that low right at 4 a.m. in London. And that's when we get that sweep of the previous day low right there. And I went long in New York, and then I got swept against again, and then it just chopped all day and was disgusting. So you notice my daily bias is right pretty much all week. I took 3 losing trades, and it happens. That's a part of the game. Sometimes you have the right daily bias, you take losing trades, whatever. But the most important thing is that we recognized and we just called, 20 days of daily price action very accurately, extremely accurately. Only a few days was kind of up in the air, right? Like this Friday, we might have wanted it to reach down into this low, but it definitely offered the other low, even though a lot of us took the long trade, right? A lot of us took this long trade in the AM session, and then we got wicked one more time. And that's why I said it would have been better to wait for another stop hunt, and then this trade would have been better. But I'm pretty sure if you're able to replicate this with 80% efficiency on just the daily chart, you're now going to have access to answering that question, right? The most important question in trading is, what direction is the daily candle going in? Why? I trade with that direction if possible. Right? There you go. You want to trade with that daily candle direction. And then you can start to build more nuanced arguments like we did here, right? On the Thursday. On the Thursday, what did we say we want to do? We said, oh, we have a very clear 2-phase move that we want to see. We want to see manipulation of this daily high, and then we want to see distribution into this daily low. Just looking at the daily chart, using IRL from ERL. Fantastic. What does the next day do? Gives us exactly that, right? ERL into IRL. Okay, cool. I'm going to end the recording there and then answer any questions.